Thank you, Paul, and good morning. I'm very pleased to be here with the Senior Deputy Governor to discuss today's monetary policy decision. Today, Governing Council maintained the policy interest rate at 2 3/4%. Uncertainty remains high. The Canadian economy is softer, but not sharply weaker. And we've seen some firmness in recent inflation data. Against this backdrop, we decided to hold the policy rate unchanged as we continue to gain more information on U.S. trade policy and its impacts. Aujourd'hui, le Conseil de direction a maintenu le taux directeur à 2,75. L'incertitude reste élevée. L'économie canadienne s'est affaiblie, mais pas de façon marquée. Et les récentes données sur l'inflation sont légèrement plus fortes que prévu. Dans ce contexte, on a décidé de laisser le taux directeur inchangé le temps d'amasser plus d'informations sur la politique commerciale américaine et ses effets. Le conflit commercial déclenché par les États-Unis reste le plus grand obstacle pour l'économie canadienne. The trade conflict initiated by the United States remains the biggest headwind facing the Canadian economy. Since our April decision, the U.S. administration has continued to increase and roll back various tariffs. China and the United States have stepped back from extremely high tariffs, and bilateral trade negotiations have begun with a number of countries. The extreme financial turmoil we saw in April has moderated, and stock markets have recovered their losses. However, the outcomes of the trade negotiations are highly uncertain. Tariffs are well above their levels at the beginning of 2025, and new trade actions are still being threatened. The recent further increases in U.S. tariffs on steel and aluminum announced today underline the unpredictability of U.S. trade policy. In addition to the uncertainty about U.S. tariffs, there's also uncertainty about their impacts. At its April decision, Governing Council said it would pay close attention to 4 things: the extent to which higher tariffs reduce demand for Canadian exports, how much this spills over into business investment, employment, and consumer spending, how much and how quickly cost increases are passed on to consumer prices, and how inflation expectations evolve. Since then, there is partial information on some of these risks and uncertainties. Let me provide an update. So far, the U.S. economy has proven resilient. Imports were strong as businesses tried to get ahead of tariffs, and that pulled down first quarter U.S. GDP. But domestic demand remained relatively strong. Early indicators for the second quarter suggest a rebound in growth as imports fall back and domestic demand continues to expand. The flip side of the strength in U.S. imports was a surge in Canadian exports. This boosted first quarter GDP growth in Canada, which came in at 2.2%, slightly stronger than the bank had forecast. The composition of growth was largely as expected. Exports and inventories were strong, but final domestic demand was roughly flat. Strong spending on machinery and equipment held up growth in business investment by more than expected. Consumer spending slowed from a very strong fourth quarter pace, but continued to grow despite a sharp drop in consumer confidence. Housing activity contracted as resales fell significantly, and government spending also declined. The labor market has weakened, with job losses concentrated in trade-intensive sectors. The unemployment rate rose to 6.9% in April. So far, employment has held up across sectors that are less exposed to trade. But businesses are generally telling us they plan to scale back hiring. The pull forward in exports and inventory accumulation in the first quarter borrows economic strength from the future. So the second quarter is expected to be much weaker. Spending by Canadian families and businesses has shown some resilience in the face of U.S. tariffs and heightened uncertainty. But they are likely to remain cautious, suggesting domestic spending will remain subdued. It's still too early to see the direct effects of retaliatory tariffs in consumer price data. What we can see clearly is the impact of the elimination of the consumer carbon tax. This knocked 0.6 percentage points off inflation in April, largely due to lower gasoline prices, and pulled headline inflation down to 1.7%. This tax effect will remain in the year-over-year change in the CPI for the next 11 months before falling out next April. Inflation, excluding taxes, was 2.3% in April, slightly stronger than the bank had expected and up from 2.1% in March. The bank's preferred measures of core inflation, as well as other measures of underlying inflation, moved up in April. There is some unusual volatility in inflation, but these measures suggest underlying inflation could be firmer than we thought. Higher core inflation can be partly attributed to higher goods prices, including food, and may reflect the effects of trade disruption. Many businesses are telling us they are already facing higher costs related to finding alternative suppliers and developing new markets. The bank will be watching measures of underlying inflation closely to gauge how inflationary pressures are evolving. The bank is also watching inflation expectations closely. In April, we reported consumers and businesses expect prices to rise as a result of tariffs, while longer-term inflation expectations remained well anchored. Recent surveys continue to show consumers are bracing for higher prices, and many businesses say they intend to pass on tariff costs. Le Conseil de direction va continuer d'analyser l'évolution et la force des pressions sur l'inflation, celle à la baisse due à l'affaiblissement de l'économie et celle à la hausse découlant de la montée des coûts. Pour cette décision, il y avait un consensus clair pour laisser le taux directeur inchangé afin d'amasser plus d'informations. Les avis étaient plus partagés sur la trajectoire du taux directeur. Dans l'ensemble, les membres du Conseil étaient d'avis qu'il pourrait être nécessaire de baisser le taux directeur si les droits de douane américaines et l'incertitude font ralentir l'économie et si les pressions inflationnistes dues au coût sont maîtrisées. Vu l'incertitude hors du commun, le Conseil procède avec prudence, en portant une attention particulière au risque. Cela implique d'être moins tourné vers l'avenir que d'habitude. Notre priorité est de préserver la confiance des Canadiennes et Canadiens dans la stabilité des prix pendant cette période de bouleversements mondiaux. On va continuer de soutenir la croissance économique tout en s'assurant que l'inflation reste bien maîtrisée. Governing Council will continue to assess the timing and strength of both the downward pressure on inflation from a weaker economy and the upward pressure from higher costs. At this decision, there was a clear consensus to hold the policy rate unchanged as we gain more information. We also discussed the path ahead for the policy interest rate. Here, there was more diversity of views. On balance, members thought there could be a need for a reduction in the policy rate if the economy weakens in the face of continued U.S. tariffs and uncertainty, and cost pressures on inflation are contained. Faced with unusual uncertainty, Governing Council is proceeding carefully with particular attention to the risks. This means we are being less forward-looking than usual. We are focused on ensuring that Canadians continue to have confidence in price stability through this period of global upheaval. We will continue to support economic growth while ensuring inflation remains well controlled. And with that, the Senior Deputy Governor and I will be very pleased to take your questions.
Okay, thank you, Governor. We will go to questions now, and we'll start with the reporters here in Ottawa at the bank, and after that, we'll go to those who have joined us remotely. As usual, I'm going to ask you to please limit yourself to one question so every media outlet does have a chance to ask a question, and if I forget to do so, please state your name and affiliation. Avant de poser votre question, veuillez vous identifier si je ne l'ai pas fait, et comme toujours, libre à vous de poser vos questions dans la langue officielle de votre choix. So let's go to our first question here in Ottawa, and I'm going to start with Paul Vieira from the Wall Street Journal, please.
Governor, does inflation need to slow in both May and June before senior bank officials would consider a rate cut on July 30th?
Well, as I think you're suggesting, we will get two more CPI reports before our next decision in July. And yes, we will be looking at those carefully. I guess what I would stress is we did see, well, CPI X tax moved up in April. And I think more significantly, if you look at our preferred measures of core, and in fact, if you look at a range of alternative measures of core, if you look at the distribution of price changes, the percentage above 3%, what you can see is they all moved up in April. That has got our attention. I will say, though, that there is some underlying volatility in inflation. Some of the components, particularly travel, tours, for example, have been very volatile. So you don't want to kind of over-rotate on 1 month's CPI data. But the fact that quite a number of measures of core or alternative measures of core all moved up does make you think that underlying inflation could be a little bit firmer than we thought. So, that is something we will be watching. And what we've indicated is that, look, we're looking at both those downward pressure on inflation coming from the weaker economy and the upward pressure on inflation coming from costs. And yeah, we'll have to factor all that in July.
Okay, Kevin Carmichael from The Logic, please.
Something of a follow-up on Paul's question, Governor. You said in your statement that you could be persuaded to lower rates going forward if inflation remains contained. What does contained mean? Is that contained at current levels, or do you need to see inflation come off a bit?
Well, I know you'd like us to give you like one number. Here it is. That's a line in the sand. It just doesn't work like that. I mean, there is a lot of uncertainty. We're being less forward-looking. We still need to be forward-looking. So, yeah, we're going to look. We're going to look and see. I mean, I think the big message here is, look, the Canadian economy is showing some resilience to tariffs. Yes, consumption was softer in the first quarter. You can see the impact of tariffs on consumption. But, despite a really big drop in consumer confidence, consumer spending did continue to grow in the first quarter. Business investment was actually a bit stronger than we expected in the first quarter. So, you can definitely see the impact of tariffs, but, there is some resilience. Having said that, look, the longer these tariffs go on, the longer this uncertainty goes on, the more it's going to weigh on the Canadian economy, the more that is going to put downward pressure on inflation, and we will be watching that very carefully. But we are also conscious that there are cost effects of tariffs. We're seeing that already. The trade disruption, I mean, what we're hearing from firms is that the trade disruption is already adding costs. They're looking for new suppliers. They're developing new markets. That's adding costs. And the retaliatory tariffs that put in place, that is not in the yet in the CPI data that we have. You will see that start to come in the months ahead. So we will be looking at both those things. And as I discussed in the opening statement, in our deliberations, we did talk about the future path, and the Governing Council thought that there could be a need for a further reduction in the interest rate if the tariffs continue, if that creates more weakness in the Canadian economy, and if the cost pressures coming through in inflation are contained. I wouldn't interpret that as forward guidance. That was part of our deliberations, nothing more, nothing less. The only forward guidance we can give you really is as I've already indicated, given the unusual level of uncertainty, we are proceeding carefully, and what that means is that we're being less forward-looking than usual.
Okay, let's go to Eric Hertzberg from Bloomberg, please.
Hey, good morning. Question on the loonie. Given the potential for more hedging from Canadian investors, the very low starting point of hedge ratios right now, would the bank be willing to look through any material rally in CAD within the context of its policy framework, or would you folks view that and weigh it as disinflationary?
I mean, as you know, Eric, we don't have a target for the Canadian dollar. We do, the Canadian dollar is one of the sort of balancing factors in inflation dynamics. I mean, the governor just went through in a lot of detail what we're looking at. There's no single metric we're looking at. We do think that the Canadian dollar has strengthened recently. We do think that's had some effect on inflation, but I mean, we have to weigh it against all the other dynamics. It's not a sort of, again, there's not a kind of magic formula or a single data point that we look at.
Okay, let's go to Promit Mukherjee from Thomson Reuters, please.
Good morning, Governor. Governor, considering the Q1 GDP data and the March data and the April flash estimate, where do you see the economy as currently relative to the two scenarios that you had given us in April?
Yes, the two scenarios. Well, I think the short version is U.S. trade policy continues to be very unpredictable. Look at the announcement today, or the coming into the force of the announcement today to raise double the tariffs on steel and aluminum. Since April, what have we seen? Well, we've seen President Trump continue to make announcements, rolling back some tariffs, increasing them, rolling them back. I think that the short answer is it's still a moving target. We're somewhere between the two scenarios, but it's still a moving target, and we'll have to see where things go. There's a reason why the first line of the statement was uncertainty is still high, and that's really what it's referring to. I will say, since April, the likelihood of the scenario 2, which is a pretty extreme, protracted, severe trade war, that the likelihood of that does appear to have come down somewhat. China and the U.S. has stepped back from the extremely high tariffs that they had imposed and counterimposed. And the U.S. is negotiating with a number of countries, including Canada. That has the potential to roll tariffs back at least some way. But at this point, the outcome of those negotiations remains pretty uncertain. Looking ahead to April, as I said, coming out of the G7 meeting a couple of weeks ago, I hope the situation becomes clear and we can go back to a more usual forecast, or at least a central scenario with some risks. But that's really going to depend on how things play out. So we'll see.
Okay, we'll go to the back of the room now, and Craig Lord from the Canadian Press, please.
Thanks, Governors. How is the lack of a spring budget from the federal government affecting your decision-making and forecasting at the bank?
Well, I mean, we're doing what we always do. When governments announce new spending plans, new fiscal plans, we take those on board. We build those into our outlook. So, whatever announcements come out of the government that are, they're concrete, clear plans with numbers on them, we will take those on board. With respect to the government's plan to have a budget in the fall, to be frank, the budget is not the biggest source of uncertainty facing the Canadian economy. It's U.S. tariffs.
Okay, we'll come to this side of the room now, and I'll start with Jordan Gowling, please, from the Financial Post.
Hi, Governor. How much of a role did trade disruption play in the rise of core inflation in April? Can you unpack what you're seeing in the data? Because in your earlier remarks, you said that it's kind of having some impact.
You know, to be really blunt, Jordan, it's a hard question to answer. And the reason it's hard is, so we're not seeing yet in the published CPI data the effects of retaliatory tariffs. It's still too soon to see those. So those are the ones that you can track more directly because you know what things have tariffs on them, and so you can track those prices in the CPI. And in addition to the published CPI, we also get disaggregated sort of micro CPI data. So we will be able to see, tariff versus non-tariff goods going forward, or how that is playing out. But it's too early to see that in the data yet. That will come in the coming months. However, that doesn't mean that the trade disruption isn't having any impact on prices, because certainly what we hear from businesses is they're looking for new suppliers to try to avoid tariffs. They're looking for new markets to sell their goods overseas, not in the United States, where they're subject to tariffs. Those things have costs. If the new supplier had been less expensive, they would have already been buying from the new supplier. The fact that they're going to a new one suggests it's more expensive. That has costs. But because that's spread out through many goods, it's hard to say that, it's hard to really pinpoint it at this point. The other thing that's going on, getting back to a previous question about the exchange rate depreciated. It was around 73. It went down as low as 68. It's now back 72, 73 cents. But some of that depreciation may also be coming through the goods prices we're seeing now, because it takes some time for that to get passed through. As Carolyn suggested, that's now going to, assuming the dollar stays 72, 73 cents, that'll start to work in the other direction. So, and then finally, look, 1 month CPI, there's always a bit of volatility month to month. Some of the components like travel tours have been quite volatile. As I said, we're going to get 2 more CPI reports between now and our July decision. We will be parsing this question very carefully.
Well, maybe just to add to what the governor said, this is where we're doing more outreach than we normally do. We're talking to businesses, so we're trying to, the data tells us one thing, but talking to Canadian businesses gives us the kind of information the governor's talking about, looking for new suppliers, carrying more inventory, and every time an announcement's made, businesses are left to kind of figure out what it means. All of that has costs. You're also seeing it in what businesses are telling us they anticipate is going to happen to their costs and to their prices and stuff. So we're putting a lot of weight right now on what we call soft data or intel we're getting from businesses. Our colleague Sharon Kazicki, Deputy Governor Sharon Kazicki, will be giving a speech tomorrow that'll kind of outline some of this. So.
Okay, Najud Amalis from the Globe and Mail, please.
Hi, Governor. 8 weeks ago, you cited uncertainty. Now you're citing uncertainty again, and it doesn't look like that's going to change anytime soon. So I'm wondering if this constant evolution of trade policy continues, doesn't that uncertainty alone tilt things in favor of a rate cut?
There's no question that, look, uncertainty is bad for business. It's bad for households. If you're a business and you don't know how much demand there's going to be for your product, you're obviously going to be much less to invest. So you're right. Uncertainty delays investment. It makes households more cautious. And so, yes, that will tend to weaken activity. And yes, you're seeing that in the Canadian economy. So, as I indicated, when the Governing Council deliberated about the future path for interest rates, on balance, different members had somewhat different perspectives. There was, it's not surprising, particularly given the uncertainty, there's going to be some diversity of views about how things are going to play out and what that means. But on balance, the Governing Council thought that, if this uncertainty continued, if U.S. tariffs continued, and that continued to weaken the Canadian economy, and if the costs pressures coming through on inflation were contained, yeah, there might be a need for, there could be a need for a further reduction in our policy interest rate.
Okay, Mike Lacouture, please.
Governors, thanks for taking our question. I wanted to sort of build on what Najib was saying and maybe take a step back here. As you attempt to try and provide this certainty to Canadians, how difficult is this for the two of you to sit there and try and balance all of this as things come from the United States that you can't predict and nobody else can predict? How unprecedented is this for you in the bank?
Well, look, okay, it's difficult for us, but what I'm more worried about is it's difficult for businesses that are faced with new rules of the game every week. I'm much worried about households who are worrying about the possibility that they'll lose their job. They're also trying to navigate. They don't want to pay higher prices. They're trying to navigate how are we going to find lower cost things, goods to buy that get around tariffs. So, look, it's really hard it's very difficult for everyone. I think looking forward, if Canada can get a renewed trade agreement with the United States that reduces uncertainty, the rules are clearer, and that has some durability, I think that will help everybody get on with decisions that will, to get back to Najib's question, that will reduce uncertainty, and you'll see some rebound in activity. That hasn't happened yet. The prospect is there. The sooner that happens, the better. And we're certainly, like everybody else, we're watching announcements coming out of the White House very closely. So yes, look, it makes forecasting the Canadian economy more difficult, but that's just a reflection of the fact that it's more difficult for everybody.
Okay, and our final question here in the room in Ottawa is Pamela Amadisamayo from Market News.
Good morning, Governor. The last decision had a reference to the bank potentially acting decisively if the economy broke clearly one direction or another, and that phrase is not here this time in this statement. So does that suggest that the two-sided risks have moderated a bit?
I wouldn't over-rotate on, it was there last time, it's not there this time. I mean, each time we write these, we have our deliberations, and then we write down what came out of those deliberations. I think what is there this time that wasn't there last time was we gave some indication of our reaction function as we move forward. So, yes, I think, look, we did repeat that we're continuing, given the uncertainty remains high, we are continuing to proceed carefully. That means we're being less forward-looking. And yes, look, as the situation becomes clearer, we have been clear. We will support economic activity while ensuring that inflation is well controlled.
Okay, that's it for Ottawa. We will now go to those reporters who have joined us remotely. I will remind you folks on the line, please only come off mute just to ask your question, then go back on mute as soon as you have finished so that everyone can hear the response. I'm going to start with Max Sato from Mace News before calling on Anna Pereira of the Toronto Star. So Max, please go ahead.
Thank you, Paul. Can you hear me?
Yes, very well.
Okay, Governor, my question is, many Canadian companies are still heavily reliant on U.S. market, and some obviously find it still easier to just sell their goods and services south of the border instead of relying more on interprovincial trade, even though there's not much of a barrier there, or seeking new markets overseas. How does this trend affect Canada's resilience in times of global crises in the future, and how does it affect your policy at the Bank of Canada?
Well, you are right that this is not a new feature of the Canadian economy, and in periods where we faced much weaker demand from the United States, it has had major repercussions on our Canadian economy. It happened in 08, 09. The banking crisis in the United States created a very severe recession in the United States. Demand for Canadian exports plummeted, and that really sideswiped the Canadian economy. It's happening again now. A very different source, but U.S. tariffs will reduce demand for Canadian exports. So far, we saw in the first quarter a big boost in Canadian exports as they tried to get ahead of tariffs. But unfortunately, the flip, when you pull it forward, that's going to reverse. And so we think the second quarter will be substantially weaker than the first. We think exports and inventories will kick into reverse, and that will pull GDP growth down. You are seeing the consequences. And I guess what I would stress is that, look, the longer this goes on, the bigger the consequences will be. Coming back to sort of broader Canadian policy, look, I do think this underlines something that we've actually been talking about for more than a decade. Canada's trade is very concentrated with the United States. Look, it's always going to be concentrated with the United States. Just look at a map. Canada and the United States, geography is determinant. But that doesn't mean we can't diversify our trade. And I think, this experience underlines the need to diversify our trade to overseas markets. It also underlines the opportunity to do a better job of developing our internal Canadian market. If we can substantially, comprehensively reduce interprovincial trade barriers and at the same time improve east-west transportation, there is a potential to have more trade within the country and grow our internal market rather than relying as much on north-south trade. So, look, I think, unfortunately, this where we are now underlines again that there is a need for us to diversify our trade as well as develop our own internal market.
Okay, next I am calling on Anna Pereira from the Toronto Star, and then I'll go to John McFarland from Yahoo Finance. Anna, please.
Hello, good morning. Given the current U.S. administration, it sounds like we'll be living under uncertainty for a while. So what will it take for the Bank of Canada to provide an official forecast for the economy again? And given that we've already received, some insight into this, there are some patterns, some news, do you expect it to be ready to deliver one in July at the monetary policy report release?
It is absolutely our hope that we can get back to delivering a forecast or at least a central scenario by July, Anna. A lot depends on the news we get. We just had a question about the sort of pace and volatility of trade policy announcements coming out of the U.S. So we're a little bit at the mercy of that, but certainly it is our intention to get back to a central scenario. We've talked about really the two types of uncertainty we're dealing with. There is the policy level of uncertainty, just what announcements are made and how long they actually remain in place. They have to be there long enough that we can actually digest them and produce a scenario with them. But even once we have that level of certainty, there is the next layer, which is how do those policy announcements feed through the economy and affect things like growth and inflation and employment and all those things. So you sort of need to get to a certain level of resolution on the first layer of uncertainty to get to the next one. And that's really what a forecast does, is it gets to that second layer of variables. So it is it is our hope and our expectation that by July we'll be back there, but we'll need to wait and see.
Okay, John McFarland from Yahoo Finance before we wrap it up with Rob McClister. Go ahead, John.
Hi, thanks for taking my question. You said there was a diversity of views on the path ahead and that there could be a need for a cut. We'll see the summary of deliberations coming up, of course, but I wonder if you could say more about the views expressed there, and especially the potential that we could be at what ends up being a terminal rate for now.
Well, I think you're going to have to wait for the summary of deliberations. Look, I think the message was pretty clear. We discussed this. I think different members of council have some differences. There's some differences of view on what exactly the most likely outcomes, the most likely path for U.S. policy is. There's some differences of views on the impacts those will have on the Canadian economy. But as I said, on balance, there was agreement across the Governing Council in the sense that Governing Council thought that if the tariffs continued, if the uncertainty continued, if the weakness, if there's further weakness, and if inflation is those cost pressures on inflation are contained, there could be a need for a further reduction in our policy rate. As I said, don't take that as forward guidance. Take that as part of our deliberations, no more, no less. The forward guidance, the very limited forward guidance we can give really is what I've already said. We're proceeding carefully, and we're being less forward-looking than usual.
And our final question is from Rob McClister of Mortgage Logic News. Go ahead, Rob.
Good morning. Despite all the uncertainty, Canada's stock market is hitting record highs, and that suggests at least some optimism for an eventual trade resolution and economic bounce back. So while the bank doesn't comment on specific asset prices, do you consider the market's confidence to be a leading indicator, and how does it inform your outlook on growth and monetary policy?
I mean, we've been saying for a while, Rob, that the markets appear to be optimistic, that prices are pretty high. Just a month or so ago in our financial stability report, we noted that markets look, at least in some sectors, to be priced to perfection. So, our advice or our comment on that really would just be you need to keep in mind the level of uncertainty and the potential for volatility. We saw a huge bout of volatility in early April as a result of the sort of initial round of policy announcements out of the White House. We didn't see market dysfunction, so that was a good thing. That means that there's enough sort of buffers built in for markets to absorb a certain amount of volatility. But we think that we're not out of the woods yet on that volatility, that uncertainty, though that could come back, and it's important that the different market players are sort of prepared for that.
Before we close up, there's a couple things you didn't ask us about that I wanted to comment on. The first is the forest fires.
Yeah.
We are watching the devastating forest fires in Western Canada, and we are very much thinking about the people whose lives are being terribly impacted. We very much hope these fires are brought under control, and we thank and salute the brave firefighters who are doing their very best to do that. These fires are having an economic impact. It's too early to give you an estimate. We will need to see. The situation is clearly pretty fluid. We'll need to see what the damage is. For now, the priority is clearly getting those fires under control and keeping everybody safe. And then the final thing I want to mention on a more positive note is go Oilers. Let's bring home the Stanley Cup. Thank you very much.
That does conclude today's press conference. Thank you, Governor Macklem. Senior Deputy Governor Rogers, thanks for all of you for tuning in. We'll see you next month.